Assalamu alaikum. Have a good day. Welcome to Financial Management eLearning. We are going to discuss cost accounting. We are in domain costing and control of manufacturing overhead. It's the module 11. Today we will discuss separating mixed costs, scatter graph, high-low method, and regression analysis, accounting for manufacturing overhead, analyze under applied and over applied overhead. So we know the costs are classified in terms of their behavior into three basic categories: variable cost, fixed cost, and semi-variable cost. The classification is made with a specified range of activity called an event range. This relevant range is the range over which volume is expected to fluctuate during the period of time being considered. So if we look here, we know that volume of fixed cost, this is the volume of variable cost, and is volume of mixed cost and volume of step cost. Cost classification by behavior, there are three types. That means fixed cost, variable cost, and semi-variable cost. The separating mixed cost. So semi-variable cost or cost, they contain both fixed element and variable element. If you see here, this line is fixed cost, is semi-variable line, is variable cost, and the step cost. So we have to analyze or segregate fixed cost and variable cost separately from the mixed cost. So for purpose of various types of cost analysis, semi-variable cost or mixed cost must be broken down into their fixed and variable element. Semi-variable cost contain both fixed and variable component. The analysis takes the mathematical form, which is called the cost volume formula. Y equal to A plus BX, where Y, the semi-variable cost to be broken up, X would be any given measure of activity such as production volume, sales volume, or direct labor hours. A, the fixed cost component. B, the variable rate per unit of X. So there are several methods available to separate the semi-variable expenses into the variable fixed component. They are the high-low method, the scattered graph method, the method of least squared, that's the regression analysis, Cont analysis, engineering analysis, etc. So if we see the scattered graph, with these procedures, various costs are plotted as a vertical line. The x-axis and the measurement figure, activity level such as direct labor, unit of output, percentage of capacity, or direct labor cost are plotted along a horizontal line, the x-axis. A straight line is plotted with a strata of points by visual approximation. The slope of the line is used to estimate the variable cost, and the intercept of the line, vertical axis, is considered as estimated fixed cost. We see here the following data are given for a freight company. Is the direct labor hour for the January to December is total 2,10,000 and cost are 34,20,000. So if we see here fixed and variable cost through the scatter graph supervision method, we will see that there are separate steps. Number one, first steps is constructing a scatter graph requires plotting each of the observation on graph paper. The second step is putting a regression line or trend line to the data. In the chart, line B, this one, line B is plotted by visual inspection, and ideally there should be many dots about the line. So another line is drawn parallel to the base on the form of the point of the intersection of yx, which is here taka 2,20,000. Look here, this one. And this line A represent the fixed portion of the expression of all level of activities, which a reasonable range. The triangle from the by line A to B show the increase in the expenses as the direct labor hour. So fixed expense per month 2,20,000, fixed expense per year. If we multiply this by the 12 for the month, then we will get 26,40,000, and subtracting the fixed portion from the total expense, then we'll get 7,80,000. This 7,80,000 is the total variable portion of the expenses. So variable cost per direct labor hour, 7,80,000 divided by 2,10,000 direct labor hour, then we'll get 3.7 per hour. Thus, expenses contains of 2,20,000 fixed expenses and variable factor as taka 3.7 per unit direct labor hour. So on the study graph, although the point of the scattered a definite upward line or cost trend in relation to the volume is clearly apparent. Factored overhead at 23 hours of direct labor is taka 25, and fixed cost component is taka 6. Draw the scatter graph. So if we do it from here, look here, since the regression line obtained the visual inspection, the factored overhead exceeds as taka 6 point, that amount represent the fixed cost component computed as factory overhead at 23 hours at direct labor, and that means 25, and less fixed cost component taka 6, so variable cost component is 19. So therefore the variable rate per hour is taka 19 divided by 23 hours, then 0.8261 per direct labor hour. So the summary based on the scatter graph method, we often hear y bar equal to taka 6 plus 0.8261 x, where y bar is the estimated factory overhead and x is the direct labor hour. Look here, this is the graph, so is the scatter graph. High-low method. This approach, that is high-low method, consists the difference in total cost between two different volume, divides the incremental cost by the volume, as the words high and low imply the two levels of volume chosen are the highest and the lowest for the periods under review. The result of this division is the estimated variable cost per unit. What we have to do, we do step one, we have to select the highest pair of the and the lowest pair, and we have to compute the variable within this B using the formula, and the formula would be here. Look, this should be formula, and variable rate defines in a cost, it's y divided by differences activity is the x. So we have to compute the fixed cost portion as the fixed cost portion equal to total semi-variable cost minus variable cost. Also, if we see the formula here, variable cost per unit would be highest activity cost minus lowest activity cost divided by highest activity units minus lowest activity units, and the fixed cost we can calculate the highest activity cost minus variable cost per unit multiplied by highest activity units. So is the formula of a high-low method. And if we see here a problem is high-low method, if a company incur the following cost in to periods, high and low, in which 5,000 units and 10,000 units were produced. And look here, so cost incurred for the 5,000 units and cost incurred in the 10,000 units. So insurance on factory building relatively the same, and the depreciation of machinery, units of output method at the rate like 80 per unit, so 4 lakh, and indirect material 4,50,000 and 7 lakh. So we have to find out the fixed cost from this figure by the formula of high-low method. Look here. Since the insurance is constant at the 2 volume, there is no variable component within the insurance cost, and since 100% increase in the volume result in 100% increase in depreciation, there is no fixed component in this both these two figures, because 3 lakh and the depreciation 4 lakh under the 5,000 units production. 10,000 unit production is the straight double 8 lakh. So only variable component will only the fixed component in the indirect material within this figure. Okay. So separation is made as follows. Variable component is indirect material cost for 10,000 units 7 lakh, and indirect material cost under 5,000 units 4,50,000. So cost of production of additional 5,000 units is 2,50,000. So variable cost per unit 2,50,000 divided by 5,000 units, we got 50. So fixed component 5,000 units, 5,000 units under the 10,000 units. So fixed component here total indirect material cost 4,50,000, and under the 10,000 units 7 lakh. So 4,50,000 under the 10,000 units is 7 lakh, and a variable components of taka 50 per unit which is calculated here, and that would be 50 multiplied by 5,000 units, and we will get 2,50,000, and 50 multiplied by 10,000 units, we will get 5 lakh. So if we minus from this 4,50,000, then we will get fixed component for 2 lakh for the 5,000 units, and fixed component 2 lakh for the 10,000 units. Indirect material, there are 2 lakh is the fixed cost. Okay. So another one, manufacturing company 12-month observation, I think, and under the B, you do it yourself. Solution with this sheet. Please download this sheet for my Google Drive. Now the method of least squares used to equation for the straight line y equal to a plus bx, which is the fixed element, and the b the degree of variability. From many accounting appreciation, regression provides an accurate estimate of fixed and variable cost. So this is the formula for look here. This b is the slope, a is the y intercepts, and total linear regression method of least square we can calculate through this mathematical equation. And here the variable cost per unit would be b, and fixed cost would be a. Here mathematical representation here saying that it is the mathematical method, and with the givens to the pitted trend lines for the set of data in such a manner that follow to condition of the satisfied number one and number two. Number one, the sum of the deviations of the actual values of the y and the computed values of the y is 0. The sum of the squares of the deviations of the actual values and the computed values is least. It would be the you have to satisfy these two conditions for doing under this method. For circular line, look here. We have seen this previously also, the same. Okay, the method of least square problem here. We know the method of least square is a procedure of determine the best fit line to data. Period 2006 to 14, and Y is used to simple calculator the linear algebra. So given this data, we have to fit a straight line trend and to given the data using the least square method. So look here, total of 9 observations there. The base period, that means origin, at the year 2010, for which x is assumed to be 0. So look here, this is the origin for the 2010. So here, so y 4, 7, 7, 8, 9, 13 is the summation of y is 90, and x 10 is the 0, so 11 is 1, 12 is 2, 13 is 3, 4 is warrior is and also same way 9 is 0 to 2009 is -1, -2, -3, and -4. Here is 4 years, and here also 4 years, and it is the middle of 2010. It's this -4 multiplied by 4, that's mean xy is -16, and square of x is 16, that means 4. So this total figure is the negative reason is here, is this plot is negative side and is the positive side. So after getting all data, if we summarize the data, then we'll get this figure. So from the above table, we find the value of n is 9. So here 9 years, and value of summation of y is 90. This 90. Summation x is 0, summation of x is 88, and summation of x square is 60. So submitting that value of the two given equation, that we will get this equal to a 10, b is 1.47. So trend equation is y equal to 10 plus 1.47x. Okay, so accounting for manufacturing overhead. So manufacturing overhead must be included in the cost of work in progress inventory and finished goods inventory on a manufacturer's balance sheet, as well as the cost of goods sold in terms of the income statement. So also we know that manufacturing overhead is all indirect cost included during the production process. This overhead is applied to the units produced within a reporting period. And if you see a few examples of manufacturing overhead, is the depreciation on the equipment, property tax of the factory building, factory land, and salaries for maintenance for the personnel, salaries for manufacturing managers, salaries for the material management staff, salaries for the quality control staff, supplies not directly associated with the production, utilities of the factories, wages, building, etc. are the manufacturing overhead. If you see here, so manufacturing costs that cannot be traced directly to specific units produced. For the accounting purpose, all manufacturing overhead costs are accumulated as debits to the single general ledger account. And manufacturing overhead, that means if you see here, manufacturing overhead, that means depreciation of plant and equipment, it would be a debit, and accumulated depreciation plant equipment would be credit. So manufacturing overhead plant utilities, it would be a debit, and cash or bank would be credit. And manufacturing overhead plant insurance, it will be debit, and manufacturing insurance plant is credit. And manufacturing overhead property tax plant debit, and property tax payable credit. And when it is the general few journals here. So if we see manufacturing overhead, overhead here, indirect material, indirect labor, depreciation, plant and equipment, plant utility, plant insurance, property tax, etc., and total overhead would be the summation of the total figure here. So factory overhead T accounts and related account, we see that the factory overhead account include the following information: that zero beginning balance, overhead cost debit, overhead cost transferred, and zero ending balance would be. So if we see here the factory T account, look here is the debit beginning balance, inventory, credit, others accounts, actual overhead incurred, and overhead applied to work in progress, the debit work in progress inventory. This is the T account of factory overhead. So if we see here for at the beginning of the period, we estimate the total manufacturing overhead cost, then we divide is estimated total unit in the allocation basis, and then we will get the predetermined overhead rate. And during the period, so predetermined overhead rate multiplied by actual total units of the allocation base incurred during the period, then we will get the total manufacturing overhead applied. And at the end of the period, actual total manufacturing overhead cost, then we minus from that and total manufacturing overhead applied, then we get the under applied or over applied overhead. Apportionment of overhead expense. So we think that there are this apportionment, that means store service expense. In the basis apportionment would be value of the material consumed. Factory rent is the basis for the apportionment. This is floor area. So this is all listed here. Just read it. And the analysis of under applied and over applied overhead. So since the predetermined overhead rate is estimated before the period of beginnings, and based on the entirely estimated data, the overhead costs applied to work in process will generally differ from the amount of overhead costs actually incurred during the period. That's why we know that the difference between the overhead cost applied to work in progress and the actual overhead cost of a period is terms as either under applied overhead or over applied overhead. So look here. So over applied manufacturing overhead, that means applied overhead is greater than actual overhead, then we can say that is the over applied manufacturing overhead. And applied overhead less than the actual overhead, then it would be the under applied manufacturing overhead. So overhead variance analysis we do, or overall net factory overhead variance analysis, controllable variance analysis, volume variance, spending variance, idle capacity variance, efficiency variance, variable efficiency variance, fixed efficiency variance, and we also will know all things in our standard costing chapter. So overhead variance we look here, actual result, and if we differ from the flexible budget, then controllable variance comes, and from the flexible budget to the applied, then volume variance comes. So overall or net factory overhead variance, difference between actually incurred factory overhead and expenses charged into process using the standard factory overhead rate. So overhead variance equal to actual overhead minus overhead charged to the production. Also factory overhead controllable variance here, this is the formula. Same way factory overhead volume variance, this is the formula. Also the factory overhead spending variance, actual factory overhead minus budgeted allowance based on the actual hour work. Actual hour work, budgeted fixed expenses budgeted plus variable expenses, actual hour work plus variable overhead rate. So factory overhead idle capacity, that allows based on the actual hour work as a standard overhead rate. So factory overhead efficiency variance, this we can calculate through this formula, and variable overhead efficiency variance, this way we can calculate. So we have to study it more. So fixed overhead efficiency variance, this way we can calculate it. So being a professional accountant, you have to understand all things and you have to study more, download this sheet. And so a treatment of over-under absorption of overhead. So if under-absorbed and over-absorbed overhead rate of small value, then it should be transferred to the costing profit and loss account. So if nominal, then it would be transfer costing profit and loss. If under and over absorption occurs due to a wrong estimated, then cost of production manufacturing should be adjusted accordingly. Okay, so if the same accrued due to the same abnormal reasons, the same should be transferred to the costing profit and loss account. So this is the treatment of over or under absorption of overhead. So look here, this a few question is if it comes in your exam. So fixed and variable overhead calculated using high-low method. Do it in yourself. Solution is here, easy way. You can do it. You will be able to do it. Clear. Head variance calculation. All are calculated here. Variable CG. Solution is here. So basic variance analysis, competition, material, labor, and a variable overhead variance. 3 items is putting here. So material variance, labor variance, and variable overhead variance all calculated here. And under the 48, scattered diagram we also discussed in previously. So look here and calculate it. And now one for analytical or accounting approach, we can segregate the fixed cost and variable cost from the mixed cost. The following are the maintenance cost incurred in the machine shop for the 6 month corresponding machine hours. So here 6 month, that means January to June, total machine hour is 12,000 and maintenance cost is 18 lakh. So we have to analyze this cost, have to analyze and segregate the variable and fixed cost from that. So look, here is the easy way. A competition of variable cost and fixed cost has been done according to the range method or accounting analysis method. High point April, look here. Here high point April is the middle, also is the high, machine hour 2,400 is the highest. So look here, so 2,400 machine hour in the April, highest point is the maintenance cost 3,40,000 and lowest point is 1,700. If you see here, which is the lowest one? So lowest one is in the March, 1,700. So in the lowest point is March 1,700. So a difference is machine hour in the April and March is 700. Same way the maintenance cost 70,000. So variable cost for a machine hour change in the maintenance cost. That means 70,000 and divided by change in the hour 700. So is 100 taka for variable cost per machine hour. Now total variable cost for 2,400 machine hour will be 2,400 multiplied by 100 taka, then 2,40,000. So fixed cost will be 3,40,000 minus 2,40,000, then we'll get 1 lakh. This 1 lakh is the fixed cost. So analyze maintenance cost into fixed and variable element. So January machine hour 2,000. So maintenance cost 3 lakh. Here fixed cost is 1 lakh that we calculate just now. And so all month fixed cost is 1 lakh. So difference from the maintenance total cost minus the fixed cost, then we'll get the variable cost per month. So January 2 lakh, February 2 lakh 20, March 1,70,000, April 2 lakh 40, May 1 lakh 80, June 1 lakh 90. So okay. Now problem 50, overhead charge for the 4 commonly used method and one of the four variants. So this question, 4 method we calculate. It's very much easy for you, just do it. And another question, question B, we have to calculate the total overhead, have to calculate total overhead, factory overhead variance, 2 variance, 3 variance, and 4 variance. So here we are putting here 2 variance means controllable variance and volume variance. 3 variance means spending variance, idle capacity variance, and efficiency variance. And 4 variance means spending variance, idle capacity variance, variable efficiency variance, and fixed efficiency variance. So these 4 is variance, 2 variance, 3 variance, 4 variance, have to calculate from this figure, and I will this will see the solution in my sheet, please. Also I will do it in my another module. It's all for today. We discussed separating mixed costs, scatter graph, high-low method, regression analysis, accounting for manufacturing overhead, analysis of underapplied, overapplied overhead under the costing and control of manufacturing overhead. And I think it's all for today. Inshallah, we'll meet with you again with my next module. Till then, take care. Allah Hafiz.